Hi everyone, welcome back to the Aussie Expat Podcast. Today we are excited to spend a fair bit of time breaking down, how would you say it, structuring different assets while you're offshore, and then understanding the differences between them when you're onshore versus offshore.
Yep, some very common questions.
Yes, common questions, a lot of ground to cover, so I think it'll be quite an in-depth episode. But
Are you caffeinated, Tim?
yeah, it can never.
You caffeinated, Jamie?
I'm ready.
Ready. Awesome.
Born ready.
I think I am. No, I am.
Yeah.
Let's do it.
Born ready, Tristan.
That's it. Very exciting.
So I think my thinking for today is the best way we can do it is break it down between maybe different asset classes, and then we can kind of talk about how they're treated when you're onshore versus the differences when you're offshore, and common tips, pitfalls where we see people get in trouble.
Yep.
So the first area I want to start on would be shares and listed investments. So let's start with treating them as an asset when you're onshore. Why? What are some of the common tax rules for when you're investing in Australia, and how do they differ when you're away? Maybe Tristan, do you want to go first on the tax side?
Good old tax angle. Yeah. So look, so when you're onshore, the sort of things you think about is the franking credits. A lot of basically who's going to utilise the franking credits, how they're going to soften your tax bill in the future.
Yes. And franking credits are so once the company pays a dividend, that company has paid tax in Australia, right? So the franking credit is the tax credit per se for the tax that's already been paid. Yep. So you're not being double taxed on that income personally when it's already been paid by the company.
Exactly, and also whose name is it in? So that's the thing. So if everyone's living and working in Australia, they're on top marginal tax rates. If you receive additional dividends on top of that, you're going to pay top up tax. So it's one of those things of if you do have a salary earner in your family group that's on a lesser, lower marginal tax rate, they're probably best placed to receive the income if they've got the asset in their name. And there's also capital gains tax as well, of course. Yes. So that's the big one. So getting access to the 50% capital gains tax discounts. Who's going to receive it? So with the 50% capital gains tax discount, you're selling shares with a maximum tax rate of 23.5%. So it's half of 47, so it'd be less than that.
To get the discount, you have to have held them for at least 12 months. Is that
correct?
Right?
Yeah, nice one.
Yeah.
Good.
I think also with the shares is you mentioned it before, who owns them and how you own them. So there's the personal ownership.
Yeah.
Family trust is very, very common. And then also potential companies or company beneficiaries and things like that.
Yeah,
Do you want to run through maybe a little bit on those and why you would use that? I think you used that example before. If someone's on 47 cents of the dollar, someone might not be working in the family unit, how that would work. And
look, that's a really good question. So the Australian Discretionary Family Trust is common structure for families that have investable assets that are sitting outside of super. So the main benefit of that is the trust is the owner of the assets. The income at the year end has to be distributed somewhere, and that can be distributed between husband or wife. It can go to the kids, but the kids need to be at least 18 years or older in order to receive a meaningful distribution. Otherwise, it's like $416. But and the other thing is, the typical structure would be discretionary trust holds the assets, and you might have a corporate beneficiary, so a company, investment company. The downside with companies is they can't receive the 50% capital gains tax discount, so it's generally a place to park income at 30%.
Yeah. I think the family trust gives you flexibility and options essentially, so you can make a decision later on down the track on where the distribution go to. Right?
I guess back in your day of Aussie-based financial advice, JB, would you set up a lot of family trusts or recommend?
Yeah, when you're looking at shares, and obviously from a share class, I suppose Australia is very inward-looking. It is about the big banks. It is about the mining companies, and they're paying that franking credit and the dividends. Where I think the difference, we'll go to this in a little bit, where we're onshore, it is about kind of the income, the dividends that are paying for you. Whereas offshore, you're more looking at more growth companies, and I think there's a little bit of a difference between that. Very rarely do you see a company, say for instance in the US, that's paying a 5 to 7% distribution.
Yes.
Whereas that can be quite easily the case with some of the big banks or even the mining companies in Oz. So it's kind of like, why are you using what's the benefit of ASX listed companies versus offshore companies? And the income play for people in retirement is a really good position for people to be in. Whereas if it's a growth asset, you're probably looking at international equities for those.
Well, I think that was probably why in Australia, a lot of places like super funds and a lot of people that are investing try to aim for higher dividend yield stocks, because there is capital gains on any growth stocks that you make, right? So it's always trying to find a balance between the two. I guess shifting then into, like, if you're investing in shares offshore, probably the biggest advantage, right? If you're living in somewhere like Singapore, Hong Kong, Dubai, capital gains as a tax disappears for you as a non-tax resident.
Yeah, and it is again, share investing versus other asset classes is you if you have $100,000 worth, you don't have to sell $100,000 worth of those shares. It gives you flexibility from that side. So shares versus property, it gives you that kind of instant liquidity essentially from that side. And then as you mentioned, when I was back at Macquarie Bank, everything was kind of on Australia shares, and kind of I thought I knew a lot about the investment well, but there is so much more to offer than essentially just the ASX type investments. And being offshore does give you access to those kind of investments as well. More global look. The one thing you do have to start looking at when you're offshore is currency, because that does have a big kind of weight on your total returns. So recently Australian dollar has been very, very weak, especially against US and the Sing dollar specifically. So AUD returns for the S&P 500 has been amplified because AUD is so weak from that side. So it is something that you have to factor in, especially as you're getting close to moving back and wanting to spend Australian dollars. That's when it becomes really important to make sure you get the most out of that FX rate.
So this is a very general question, and I know everyone's individual circumstances are different and they need to be taken into account. But do you typically find, like, when you're investing with someone when they're offshore versus when you know they're going to go back or when they've gone back to Australia, do you find that it's beneficial to reweight the portfolio to Australian-based stocks for things like the franking credits?
Yeah, I think it does. Again, when you're offshore, you don't get the benefits for franking credits.
Yes.
You do have to pay withholding tax.
Correct.
But you miss that benefit of franking credits, and essentially withholding tax is 12%, franking credits is 30%. So you're missing out on 18% kind of arbitrage essentially. So that's when people offshore are probably looking at more growth stocks and more internationally. But yes, when people go back, you are looking at that from a asset allocation perspective.
Yes.
The big thing with people who are offshore and wanting to go back is probably looking at hedging the bonds, the fixed income component. Again, if you're looking at from a pure growth position, ASX 200 over 50 years has grown like 8 or 9%. S&P 500 is about 13%. Again, that's not an indication of future performance, but it's one of those things where overseas investments have grown significantly. I saw a stat the other day where out of the 30 big currency exchanges at the moment, ASX is sitting at like a 22 for the year. So it is one of those things where you have to look at more broadly if you're looking for growth. But yeah, to answer your question, I know I've deviated a bit, but it is something that we look at for that repatriation strategy is kind of, okay, well, how much money do you need? And obviously, if you're going to Australia, you're going to need Australian dollars. So especially for the defensive allocation.
It depends what stage of life you're in as well, right?
Yeah.
So at what time you're repatriating or going back as well.
JB, there's a question I've always wondered myself, actually. So this is a
Get
good
some
one for you.
personal advice.
Personal advice. So if you are in Singapore or Hong Kong or wherever you are, and you've got obviously a local currency there, and you've got, you do have intentions to go back to Australia at some point in the future, unknown when, would you try and do your investments in AUD, or would you do it in your local currency, or USD, or how do you how do you deal with that with your client base?
Normally, if, say, for instance, obviously in Singapore, I would say look at investing in your current currency, but for the equity side of things, we don't necessarily look at hedging things. Again, if you're buying a company, you're looking at that company and what's that growth going to do for you. So
fundamentals, right?
You're going. If you want to buy Alphabet, you don't necessarily need to buy Alphabet and try and hedge that back to AUD because you're buying that stock, for instance, because that's probably what you're looking at. But yes, to your point on the Australian dollar, for instance. So if there is a big kind of disparity between say your local currency and Australian dollars, it could be at that point in times, rather than fixing something to Sing dollars or Hong Kong dollars, you might change that fixed element to, not fixed, the hedged element to Australian dollars at that point in time. The underlying asset might not change from the bond perspective, but just the hedging might change from that side.
No, that makes sense.
Yeah.
So I guess, the main thing with shares and listed investments is just understanding that, when you're in Australia, the tax rules, especially around dividend treatment and capital gains, are very different. And then obviously when you're offshore, the biggest benefit is that they're not having any capital gains tax applicable to any growth you make, which is one of the main reasons people like to invest in shares when they're offshore.
I think the big thing as well to talk about that I get asked is about the transition from onshore to offshore. If you hold shares, some of the tax things you should do, deemed disposal and things like that. So,
I got burned with that when I
did.
I had
A lot of people.
I pretended I was a sophisticated investor, and I had all these maybe 15 different individual stocks, tiny holdings, a few grand in each one, thinking I was some guru. And then I moved over, and all of a sudden I had to start finding out all this historical information about when I moved over and what the share price was. And it was 10 years ago now, so the reporting on a lot of these broker platforms was not what it is now. It was a nightmare.
Do you want to run through what it is, from a tax perspective, and maybe just talk through the options you do have for people, because that is something that does pop up a lot.
It's common things. So deemed disposal. So it's basically selling your shares for tax purposes. So not necessarily selling, but selling for tax purposes. So going back to basics of Australian resident for tax purposes, taxable and worldwide income, worldwide assets. So shares that you have globally at that point in time, in order to disconnect them from Australia for tax purposes, you need to sell them for tax purposes on the day you leave Australia. So
paper sell them. You don't actually have to physically sell them.
Correct.
Right?
Yeah,
know
exactly.
What the value is on that
exactly.
day.
Yeah, so paper sell. So it's effectively an all or nothing. So it's all the assets you got on that day, you can either elect to sell everything or you don't do it at all. So if you don't sell them for tax purposes, then they remain connected to Australia. So even if you're an expat for 10 years and sell them 10 years later, you've still got to pay capital gains tax in Australia that year that you sell them. So benefit of this is there's a little bit you've kind of got to, you can kind of stare into the future a little bit, because JB, you and me were talking about this earlier. You've got time. So for example, let's say that you went back to Australia today. Oh, sorry, no, you went to Singapore today. Sorry, or you went offshore today, which is what are we 26th of September. Just to mark this date. So you look at the actual. You look at the market valuation of the share on this day. Today we need to lodge this tax return within the 2026 financial year. And if you lodge with the tax agent, you're not actually due to lodge that until May 2027. So you've got a lot of time to decide whether you want to do deemed sale or not. Because basically when you're doing your tax return in, say, April 2027, you can look at which way the share's gone. So if it's gone up since you've or if your collective portfolio's gone up since you've moved offshore, then it's a no-brainer. Do the deemed sale, pay the tax, and that means later on when you sell it, no capital gains. But if it's gone backwards, you might go, well, I might not do the deemed sale because at some point I'm going to want to get out of this, and I'll, that way I can at least crystallize a capital loss that it'll roll forward forever and I can use it at some point in the future.
Okay.
And I think even between the time that you move overseas and the time you've got to lodge a tax return, if there is a drawdown in the market, a significant drawdown across the board, that could be a time where you just sell one day, buy the next day, essentially, because that will reset the cost base at a much lower
Exactly,
period as well.
And common question I get a lot is what about dividend reinvestment plans? So that's a similar situation to what you're talking about. So if you're constantly buying shares every time there's a dividend that's released, that'll be any shares that you buy when you're in Singapore, subject to Singapore rules, capital gains tax free from an Australian standpoint. So even if you've got Commonwealth Bank shares and you've got 100 shares that you brought over, but then the next dividend's paid and you pick up a few extra shares, those extra shares that you pick up, they're suddenly capital gains tax free. So you have this situation where your portfolio starts splitting unless you deem sell the whole thing.
Must be fun for you and spreadsheets, mate.
I just in my head, I'm just trying to think about all the work it would take to put some of these together.
It's a bit of that,
especially when everyone comes at the it's too late sometimes.
I'm very lucky. I've got some good juniors on my team that lap this thing up for breakfast. So I can just go. I can go. Yep. Here's some more deemed sales, and they say great, and they're off.
So they're very excited every time you put it in front
very
of them.
Very excited, exactly.
Very nice. Very nice.
Yep.
Great.
So the next one, obviously, we talk about shares. We can get into some other structures and assets in a moment. But a common one we get up here, especially, is private investments or unlisted investments.
Yes.
So obviously, there's a little bit of nuances between onshore and offshore. Again, kind of similar kind of tax themes as shares, but a few other things we need to consider.
Yeah. So whether it's taxable Australian real property, that's something to consider. So if you're investing in a small property company that's just got property in it, sadly you can't deem sell that because within the company it's just property. So it's not kind of a share in a company. So that's definitely one thing to think about. When you deem sell it.
So that would be, say you were, before you left Australia, you had a private investment vehicle that had investment properties underneath it.
Yep.
Right? And you had shares in that vehicle. It wouldn't be treated in the same way as another investor. It would be treated as...
Correct. Yeah, you can't just disconnect it from Australia for tax purposes. Go, you beauty, I've got all these Aussie properties that'll be capital gains tax free now.
Yes. Well, they do like to treat property differently, which we'll get into further down the line.
But on the flip side, if you've actually got genuine private equity, so you've got sort of equity even in a business, for example, you can deem sell that, which half the challenge will be working out the value of the share at that time, and that's a lot of the issues with private equity. But
do you typically find people have to pay to get valuations done if it's especially if it's their own private company?
Yeah, look at the yes. Short answer is yes, unless you've had a recent private capital raise. So if you had a recent private capital raise, you can kind of peg it to that. If not, it's basically got to pay a Australian-based valuations firm. Might be somewhere starting from like 3,000 to 5,000 to more to get the guys to value it for you, because they need to get into the business, get their head around future cash flow modelling and the business model and what it's worth on the market. So
it's a lot of
bit of work.
And the hard part is when you're look at this, the cash flow, because most business owners are putting everything they've got back into the business. So they might not have the cash that they've got. And obviously transitioning from Australia to Singapore is not a cheap exercise. When you bring your family up and things like that as well. So that cash, being able to do it is also part of it as well, because you can't necessarily sell part of your business to pay for that tax bill. So
that was it.
That's a factor that we've looked at.
Definitely. In fact, it was I think it was a client that we shared, Jamie, a while ago, where they had their actual accountant do that exercise for them, because they were moving up to Singapore to sell the company for a lot of money. And sadly, they just didn't have the money to fund the deemed sale. So they had to effectively go, look, we'll just have to pay capital gains tax on this thing when we sell it, even though we're up in Singapore, because they just had no cash left in the group and no debt facilities or anything. So they made the call.
Again, it comes down to, I guess, planning, right? And just understanding what the rules are going to be before you go.
Exactly.
So, and especially when it's a private company and it's your own business, there's a lot of emotion involved as well. Property. Big differences between when you're onshore and offshore. So we can talk about onshore first and some of the common rules in Australia, and obviously why people love property in Australia. I feel like there's a lot of strong tax incentives for people to buy property in Australia.
There is.
The most common, obviously, if you're starting with your home, any gains that you make on your family home are completely tax-free in Australia. So for a lot of people, it's been a great way that they've kind of generated wealth over time, being able to upgrade. It's an important reason that people buy and want to buy their home. But I think on the investment side, the other part of it is negative gearing is a really strong tax tool to also be able to just build wealth through property in Australia. When you get offshore, a lot of these rules become a little bit different. I think the considerations are different as well. So negative gearing is a basic concept, right? You earn rental income, you claim your expenses, borrowing and interest is probably the biggest expense out of that. If you lose money, that loss you can use to offset against other income that you earn in Australia. So
future income gains.
That's why if you're a high income earner, a lot of accountants tell you have to buy an investment property, isn't it?
Exactly. It's kind of like I guess in the old days, I sound like I'm an old guy here, but in the old days, there's like plenty of other sort of tax schemes that were sort of similar to that. Like I don't know if you guys remember the disastrous forestry schemes that were around. Probably 15 years ago or something like that, and they relied on a similar kind of negative gearing benefit where you invest in these properties with loans. You invest in these blocks of forests with loans. the initial investment was tax deductible, and so was the interest on the borrowing as well. So you just got this big bucket of losses, and sadly people weren't. They were going in for the investment purposes, and the actual forestry investment fell over. So they not only lost the tax deduction, they lost the money. But when it comes back to the actual negative gearing properties, it's still a very popular strategy for Aussie property investors, right?
It's the reason. It's got to be done right, and there's many different parts to it. There's obviously the biggest part is it only works if you pick the right properties that you're sacrificing income because you are making a loss every year, right? And that loss is real. But the trade-off is you're hopefully investing in something that will grow or have capital growth over time, right?
Yeah.
So as long as you've picked the right asset, it's been structured the right way, that's where people win. Yeah. There's bigger strategies, right? If you can buy a good growth asset and it does appreciate, you could use the equity that you have in that property to leverage to buy another property. So there's, it's a lot of what we do is people that start with one and they want to build a portfolio over time. You've got to be picking the right asset for that.
Yeah,
which is its own science.
No, it is, and it's just choosing the right asset as well,
yes.
right? As you're saying, it's similar with the share side of things. There's income producing shares and there's growth producing shares. So it is about choosing the right asset for where you are in your life cycle and what your objectives are as well.
Yeah.
And then also on the structuring side of things, how much of a loan do you get to help with that negative gearing? Obviously, anything's negative gearing means that your cash flow negative, so that means you have to actually be able to afford to pay for that shortfall.
Exactly.
And then also it's like new builds versus old builds because there's a tax depreciation side of things too, which obviously can amplify that negative gearing side of things. And I always say if you can use the bank's money to make money essentially, and obviously negative gearing has a big benefit of that from that side, and also use the jurisdiction where you've got the assets. The regulations behind it as well. So obviously in Singapore, Hong Kong, Dubai, there's no tax on income or gains from investments. Where in Australia, there's obviously the tax you're taxed on those gains, but also from the flip side, you also can deduct costs associated with trying to generate a profit. So you use, like for instance, for people overseas, you can use your money to invest in shares or assets outside of Australia, but you can the best thing from a structuring point of view is kind of using the bank's money or debt to help finance investments in Australia, so you can build up those negative gearing credits. I call them credits. You don't like the word credits.
I like the credits. I think it was an invented word in my opinion. It's but yeah, I just call it tax losses because that's what they are.
It's a good like. It's just credits to me means that the ATO owes you something, so it's good. Like it's not very often the ATO owes you something, so I like that sentiment.
Maybe a compromise is the word tax offset.
Tax offset.
You can offset the loss against future income.
Well,
right?
I had one client that bought into the whole credits, the word credit, and they were expecting they were going to get,
get the cash back each year.
Get the cash back, exactly. And when I caught up with them and did some modelling for them, and I sort of, gave them the net position, I say, right, they're like, I'm going back to Australia, here's my salary, I've got all these credits, how much will I get refunded? And I told them the refund, and they're like, what? What do you mean? I was supposed to get... they had $100,000 worth of tax losses, and I was like, well,
you don't get $100,000 back.
Yeah, exactly. You don't get $100,000 back, and it was their world just fell apart in front of me. And I felt so bad, and I was busy trying to explain to them. I was like, it's still good, but it's a credit or a tax loss just reduces your taxable income for what you taxed on. So it was one of those.
It's not a dollar for dollar. Return of money.
It was one of those awkward conversations. But offsets are better because an offset will give you the dollar for dollar. Basically.
That's it.
There you go.
Yeah, there you go.
Solve the world problems.
Exactly,
already.
solve the world problems. Exactly. Yeah.
It's a bit of a finance geek conversation as well.
It is.
Do you want to touch on the PPR and the parts from an offshore position?
Yeah.
Well, that was going to be my next question. Is your home. I mean, and we've got a whole video on this on my website as well. But understanding once you move over, how is if you've had a home before you move, how is that treated once you leave?
Yeah. Okay. So. If you had a home before, so assuming, and then you move over. So assuming you've bought the home, moved into it, established it as your principal place of residence as soon as possible, lived there for a period of time. And this is important because if you actually buy a house and rent it out for a period of time, then move into it, the the situation changes. Just to just give you that heads up. But buy the property, move into it, live for a period of time, then you get the expat transfer.
Yes.
Then move offshore. Okay, you've got the famous 6-year absence concession, which a lot of people are aware of, which basically means you can rent it out for, up to 6 years and then return back to Australia, move into it, reset the clock. Or you go beyond the 6 years, you've got like a pro rata allocation. The really super important piece of information to plug into everyone's mind is, in order to enjoy that concession, you've got to sell it when you're a resident for tax purposes. So if you mess up and sell it when you're offshore, you lose all tax concessions whatsoever.
Everything.
Everything. The only exceptions is, when bad stuff happens, like divorces and deaths and that sort of thing. And if that happens within the first 6 years, there's concessions there. Okay. If it happens beyond 6 years, there's no concessions. So, it's a, that's kind of like the key differentiator. But the property, for all intents and purposes, when you move offshore, it becomes an investment property. Your mortgage is tax deductible from the point you start renting it, or it's available for rent. Repairs and maintenance to fix it up when stuff breaks after the tenants move in, deductible. All the costs of running deductible, and depreciation if you've got depreciation on it. But you do have nasty things like land tax that do kick in on the bigger blocks of land and that sort of thing, which is also tax deductible.
Yes.
Yep.
Yeah.
Very important.
Yep.
I wanted to spend a bit of time just talking about investing in like a personal name versus a trust versus a company. Touch on a little bit with super funds as well. But yeah, again, it's this world. When you're living in Australia, the tax rules can vary quite a bit compared to when you're offshore. And there's a lot of very popular YouTube videos and spruikers of different strategies out there that I hear about every day, especially this. The most common one these days is buy every property. Sorry, if you want to build a portfolio, every time you buy, put it in its own company, its own trust, and then the bank won't ask you any more questions about the lending. So it's not as simple as they make it seem, especially when you're offshore as well. So I think just starting with companies first. And trusts, I guess, are tied into this. So most trusts that we see, especially, you typically have like a company as the trustee.
Yep.
So the biggest thing to understand when you're using a company offshore is you need to have a resident director on that company. So if it's just you and your spouse and you're using that company as your investment vehicle and you're both away, you need to have a third person as the director. A lot of people I see have a family member on their parent, or depending on their age, child, a sibling. That's probably all fine and good if you're using cash to invest with that entity, but a lot of people use those entities for property purchases. Where it can get complicated is, I'll let you talk about the tax side of it, but on the lending side, when we want to do loans through trusts or companies, almost every lender that we work with would expect that all the directors of the company provide a personal guarantee for the loan. And if you have a family member who is retired or not working, it can be a detriment to borrowing capacity. And second, it's your investment vehicle, but it might be your family. They may not be getting any direct benefit out of doing it. They might be less engaged in the process and wanting to guarantee the debt as well. They might have their own things going on too. It just can get tricky and complicated. So it's the simple lesson is it can work a certain way in Australia, but when you're offshore, possible, just more complicated and more things to think about.
A question for you, Tim. So trusts can, as you said, most trusts do have a corporate trustee, so it's a company that manages it, but there are trusts out there that have got individual trustees.
Correct.
So, you've got kind of, trust with mum and dad as trustees or similar.
Yes.
In that situation, what does the bank look at for lending capacity?
It's easier if it's individual names.
Yep.
We're still looking at the trustees own the asset on behalf of the beneficiaries of the trust, right? But the name on the title of the property and the person applying for the loan is the individual. So the assessment criteria will be the individual.
Got it.
What I find though is, a lot of people, we've talked about this a million times as well. Most people are setting up trusts these days, not necessarily for income splitting, because the ability to income split has been, especially to children, has been heavily reduced, right? The benefits are just not there. I find most of the time people are setting up trusts these days for estate planning or asset protection, really. So you don't get that if the trustee of the trust is an individual. You're kind of still back at square one.
Yeah,
again.
exactly. Yeah, because Agree. It basically, largely becomes a tax planning vehicle.
Correct.
Situation.
How wide does the web go? So say, for instance, as an individual, but they've got 5 or 6 different trusts. So this is to your point before about those different people setting up different entities for different properties, and they're buying just one in each thing. So say, for instance, Joe Smith, he's got 10 different properties with 10 different trusts. If he goes to buy another property, would they look at those different trusts that they're on as well, or is that just looking at their serviceability from that point onwards?
If the trust has a company as trustee, it can be considered in isolation, but to be able to do that, the trust needs to be self-sufficient. So you can't. Do you mind? Let me start again. So to do that, the trust needs to be self-sufficient in its own right. It can't require you to be contributing funds into the vehicle.
Property, essentially.
Correct. Correct. Which again, and to verify that can vary between different banks. You either need to have an accountant confirm that is the case for you, and accountants these days are very careful about their compliance. I think. Interesting.
Yeah, they are.
It's not as people just think they're going to rock up and their accountant's going to tell them or give them everything they need to do. But it's becoming a bigger thing because I think a lot of accounting bodies are even saying now, like, don't even write the letter in any.
Be careful because the accountant doesn't want to inadvertently be drawn into the loan effectively by guarantee, like effectively providing some form of a guarantee.
While we're on loans, in terms of companies currently, I know this changes all the time, right?
Okay. Why are you being so annoying now, hey?
Hello, miss. Okay, we'll start again.
On loans.
While we're on loans, we're obviously talking about the different structures, companies, trusts, personal. It changes all the time, but the lenders that are available to expats or people living overseas is restricted in any case for anyone, even in their personal name, and the shadings and things like that is quite challenging. But for companies, trusts, and the like, obviously, I'm assuming that comes a lot less. How many kind of banks would lend to trusts or companies offshore?
Not many. So from a mainstream lender perspective, if off the top of my head now, there's one, maybe two that would do it. Where this space is really covered is in the non-bank space. So we have quite a few non-banks that will do this, but you pay for that. So you pay for that extra service, right? Because they're filling a gap in the market that the major banks won't do. So typically the rate might be 1 to 1.5% higher of what a standard on investment loan might be. The fees might be 1% of the loan amount. So definitely, like I said, there's always a solution to everything. It just depends on how much it costs you to do it.
And that's a big thing, right? It's like you might be able to save some tax or from a structural point of view, but the holding costs might be negligible to the actual potential tax benefit and things like that. So.
And the other thing to remember is, and maybe I'm stepping on Tristan's toes with the tax side of it, but
right. Like all Aussies love to talk about tax. Yeah. I don't have the exclusive rights to be the only one talking about tax. So
I just give commentary. I don't give advice.
Sure.
Just things to think about, and then go and talk to someone that can confirm it. The biggest thing are negative gearing benefits or any capital gain losses or gain benefits are self-contained in that trust or company. So especially if you want negative gearing benefits in the future to be, again, say your salary income when you go home, if you've got your property in trust, it's not there.
Correct.
So,
makes it difficult.
Happy to rubber stamp that for you.
Write a letter for it.
Yes,
you're self-containing everything.
Tim's tax advice, non-tax advice, non-tax advice.
Just
general advice.
Things to think about, Tristan. That's what I always say.
On the structure side of things, T, Singapore trusts, Singapore companies, when people go back the other way. So a lot of people as I speak to have got companies offshore thinking that, or they want to put assets into a company offshore, go back to Australia and say, okay, well, even though I own it, I benefit from that and I control that. They won't pay Australian tax. Do you want to kind of talk through that situation?
Very happy to. Yeah. So look, it's if you're a shareholder of a Singapore company and you go back to Australia, if you're seen to manage and control that, and the ATO have got quite a rigid list of tests for that. That company effectively gets dragged into Australia and has to refile. So,
So the company itself has to be
basically
resident or has to lodge a return in Australia.
Has to lodge a return for Australia. So it's you still do the Singapore obligations as you normally would, but then the company has to effectively refile in Australia. So how we get around that is you either get a resident director in Singapore, so someone that's more than a nominee. So they're actually doing director's duties, helping essentially manage and control the business. So if it was a business and you've got a trusted employee, you would obviously carefully consider it, but put them on as the resident Singapore director.
Yeah.
And they'll be making the central management and control decisions from Singapore. Like maybe you're up in Singapore at the time that it's happening, but they're sort of your front person of the company. That would keep the company out of taxation for that point in time, but it doesn't make the taxation liability go away. So, for example, the company makes a dividend, pays a dividend to you. The dividends don't pay nicely. Yeah, they're taxable in Australia and they don't flow nicely because Singapore doesn't tax dividends. So when a dividend is paid to an Australian resident, you basically pay double tax. And kind of how it works is you make $100 in a Singapore company, you pay 17 cents, which is the corporate tax rate up here. You're left with $83 in the bank account. You then say, I'm going to pay the $83 dividend down to Jamie, who's in Australia, as an Australian tax resident. Jamie receives a dividend and the tax man says, I recognise that as an $83 dividend. So then
there's
they
no
tax
tax
you,
credit.
No tax credit. So then Jamie gets taxed his top marginal
No,
tax
there's
rate.
no tax credit. There's no tax offset.
Yes,
right?
thank you. Yes, exactly. Yes, exactly. Yeah. There's no franking credit. I would say that word. No franking credit. So so effectively, and let's say if Jamie's on top marginal tax rate, he's already paying 47 on it, and then he pays another 17. So it's disastrous.
Yes.
Yeah.
Well, I see it with some people think they can just set up an investment company here, do their investing through that company, go home, and because it's self-contained in a company, it's not visible or you're not paying capital gains tax or anything on it. But it's definitely, the ATO is very aware of all of that.
Yeah.
They are.
And Singapore and Australia have very strong data sharing laws as well, so and reporting obligations with each other too. So
Definitely.
can't hide.
Yeah. So that's the Singapore company. So just important to note that on Singapore companies, Singapore trusts.
Yeah.
If it's a standard Singapore trust, the same sort of rules apply as well. So you've got kind of transfer of trust rules. So it looks at who contributed the money to the trust, and if you sort of put the money in a Singapore trust as a Australian tax resident, you're effectively deemed to have effectively still be in control of that money. So therefore, you've got to kind of report the annual earnings and distribute them and alike. There's definitely vehicles that work up here. So there's things like the Foreign Superannuation Fund, which is a Singapore trust with an Australian compliance pension trust deed, and there's also the offshore investment account as well. We call them tax wrappers. What would you normally call them, Jamie?
We've got 1,000 different names.
1,000 names.
Yeah, insurance bonds,
Insurance bonds,
investment. I think
Yeah.
the ATO calls them foreign life insurance.
Foreign life insurance policies.
policies,
Yeah, exactly. Yeah. But
PPLIs, private placement life insurances.
Yes.
There's a whole raft of different names
yes,
for them.
exactly. Depends on who you're talking to at the time, but they work for tax purposes. So in the sense that there's and their kind of rules is basically the assets are contributed to the account. They have to stay in there for 10 years. After 10 years, they're tax free in Australia. Prior to that, there's even strategies. I think Jamie, you work with clients on strategies in taking some of the assets out prior to the 10 years.
Yep.
Pay some tax on it, but the rest of the assets are kept within the structure. See out the balance of the 10 years, and there's certain contribution rules as well, like the 125% test, meaning you can't just dump a heap of cash in there towards the end of its 10-year run and expect everything to be tax-free after that.
Yeah. I do get asked about this a lot, and it is kind of one of the things that I help clients with. The easiest way that I explain it is there's ATO rulings and there's the platform itself.
Yes.
So people think that it is locked in for 10 years.
They do.
Which you mentioned, which we're definitely not. And that part of that repatriation is kind of that restructuring side of things. So whether you've got employee shares, bonds, alternative investments and things like that, it is a very tax efficient structure to kind of take the benefits of Hong Kong, Singapore, Dubai, in terms of the tax treatment of investments back to Australia.
Yep.
As you pointed out, there is some kind of key considerations that you have to take into consideration when you're in Australia, but if you are offshore, they are flexible to put things into from a tax perspective, for an investment perspective, and previously they were difficult structures because it was kind of you didn't have a very big investment options. You probably had 20 or 30 different managed funds that were very expensive. The life has changed a lot since kind of financial planning 20 years ago.
Yeah.
Unfortunately, I still get called a couple of those names from previous from previous advisors who have set some of these old school kind of structures up and charged ridiculous amounts of commission and kind of hid those commissions. And there's things like FOFA up here, or FOFA in Australia, FAIR up here. The UK is going through some, and those kind of best interest duties are kind of making sure that the client is looked after, and those kind of old school products and commissions are kind of getting removed, which they quite rightly should.
What's she doing?
Wait, Rico, what are you doing? Come here. She's like, I'm not moving.
I feel like we almost like need to get her on just so people can like understand.
Understand
what is
what's
this
happening.
noise?
Yeah.
Hey, very demanding. You want to say hello to everyone? So we've covered a lot of ground today. I mean, we covered listed investments, unlisted investments, property, some basic idea of structures and things to look out for. Maybe we can summarize for each of us what would be like your top tip or tips for people just to think about when they're thinking about structuring when they're offshore. Jen?
For the offshore section, I would probably say the number one tip is kind of utilize the regulations that you're in, and also the regulations you've got assets in. So maximize, I suppose, the tax deductibility of holding investments in Australia, and also maximize the tax-free nature of investments offshore as well, and kind of look at the different regulations and jurisdictions to optimize your assets from that side. The structure is important. So obviously, from my side, obviously looking at those insurance wrappers or the PPLIs, I think is a very important piece. And start early rather than kind of waiting till 2 weeks before you go home and say, what do I need to do? I'm going to start paying tax on this big chunk of money. And the last one is, it's very simple and very basic, but it's about something that I think all of us are probably guilty of, is like make sure you've got a cash buffer and do budgeting. It's very easy to have income creep and where your income increases significantly when you're offshore. Most likely your expenses increase in conjunction to that. So I'm as guilty as it is as everyone, but it's kind of try not to keep up with the Joneses because it is quite expensive to do that. So it's kind of utilize your regulations in your jurisdiction, look at different structures, and then also make sure you keep your budget in check.
Cash open. And that good old IRAS bill when you leave Singapore is a killer. So you know, the old if you've got sort of shares that are unvested that you bring back to Australia, you got to pay tax on those on the way out the door. That is a regular conversation I have with a lot of clients. Some of them know about it, some of them don't.
Yes.
And also, you know, if you're paying tax, you know, the good old gyro system of paying in arrears, interest-free, which is pretty good. Everything has to come home to roost before you're allowed to leave Changi Airport. So just remember that too, guys.
Yes, you probably won't get your last pay.
Exactly. Yeah, that's a big one. Yeah.
More.
I think my main thing is, like I said before, there's a lot of spruikers, YouTubers, TikTokers that tell you things that you should be doing, but quite often they just don't apply in the same way when you're offshore. So it's the same thing. We always say, actually get some advice about it, and really, before you do something, just really understand it.
Yeah.
Don't just go in blind because someone else told you to do it. Really try and understand, why does this work and how does it work?
Exactly. It's the sort of stuff I keep telling my daughter. If you've heard it on YouTube, doesn't mean it's real. And she's trying to tell me about the latest Korean skincare. I think so. Yes.
Yes.
Important, and consider your circumstances. My offshore tips would be structuring. So look, I genuinely say, it's worth having a look at the kind of structures available to up here. So the wrappers have come a long way in the time that me and Jamie have been working together. exactly from the old school, 20-year lockups, which are, should be illegal, to now the nice open architecture, vehicles that, could, tax-free in 10 years is pretty good. And you've got flexibility to, work with a friendly advisor like Jamie and, and set it up, to your preferences. So they're pretty good. Property structuring for losses as well. So when you're up here and you're about to buy a property, think about the flow on. So think about, okay, so we're buying the property today. What's going to happen when we return to Australia? Do I want the losses to flow 50-50 to me and my partner, or should it all be in my name or my partner's name because they're earning more money and I'm going to take some time off when I'm back in Australia? So think about that kind of the flow through of if you are getting into collect some tax losses, gentlemen, just put that out there. Just think about where it's going.
Just thinking about tomorrow.
Yep.
Not just where you are today. It's probably the number one thing. Yep. So, cool. Thanks, guys. Appreciate it like always.
Thank you. If you like the podcast, give us a like and share with at least one person.
It's good. Easy ask. Yeah.
Like and subscribe.
Even your mum. She'll. Sure.
She definitely.
Hi to everyone's mum out there.
We covered a lot of ground today. I feel like there's a lot of information in. Understanding all the different structures, different. Sorry, let me get rid of it now.
Should we just talk about the elephant in the room here? Because for the people watching
on
this,
the bloopers,
you were just we're talking about tax and structuring, and then suddenly the dog appears.
Yes,
got very excited.
Very excited. Yeah, exactly.
Yes. She loves having the boys around to talk finance.
And who's this again?
Riku.
This is Riku.
Yes.
This is Tim's fur baby.
Yes. Miss Queen.
The Aussie Expat Podcast
exactly.
mascot.
Yeah, mascot, exactly. Everyone needs a good
I
mascot.
think she was in some Anza ads for a while too.
Yeah.
So.
Oh, she was, yes. Yeah. Do you want to talk about tax and structuring?
Yeah.
She almost fell asleep.
All right. Let's finish up this one. Yep. We've covered a lot of ground